China's retail sales in May grew at their fastest rate since late 2023, as government subsidies helped boost consumption, with analysts calling for stronger policy support to sustain the recovery. Retail sales last month jumped 6.4% from a year earlier. Data from National Bureau of Statistics showed Monday, sharply beating analysts' estimates for a 5% growth in a Reuters poll, and accelerating from the 5.1% growth in the previous month. The spike in sales growth comes as a welcome respite for the world's second-largest economy that has been struggling with persistent deflation. Ling Fu, NBS spokesperson, attributed the improving consumption in May to the ongoing consumer goods trade-in program, a surge in online shopping ahead of the 618 e-commerce event, and a rise in foreign tourists as the country expanded its visa-free entry list to include more countries. However, he added that it has been particularly challenging for China's economy to maintain stable growth since the second quarter, naming heightened uncertainty in trade policies among factors dragging growth. Fu made the comments at a press conference following the data release. The country's industrial output slowed to 5.8% year-on-year in May, from 6.1% in the prior month. The latest reading came in slightly weaker than analysts' expectations for a 5.9% rise. Fixed asset investment, reported on a year-to-date basis, expanded 3.7% this year as of May from a year earlier, undershooting Reuters' forecast for a 3.9% growth and slowing from a 4% growth in the first 4 months. Within the fixed asset investment, the contraction in property investment deepened, falling 10.7% in the first 5 months, government data showed. The rise of retail sales came as a surprise, said Jiwei Zhang, president and chief economist at Pinpoint Asset Management, while cautioning that the falling property prices could dampen consumer sentiment. A separate release Monday by the NBS showed prices of new homes in the more affluent Tier 1 cities continued to decline, falling 1.7% in May from a year ago, while those in Tier 2 and Tier 3 cities dropped 3.5% and 4.9% respectively. The NBS official noted that more work was needed to stop the slump in real estate market. A tariff deal reached by Beijing and Washington in mid-May gave temporary relief to the country's exports, prompting some businesses to front-load shipment while doubling down on alternative markets. Both sides struck a 90-day truce to roll back most of the triple-digit levies added on each other's goods in early April. Commerce Secretary Howard Lutnick told CNBC last week that U.S. tariffs on Chinese imports will stay at their current level of 55%. China's exports grew less than expected in May, though surging shipments to Southeast Asian nations, European Union countries, and Africa helped offset the sharp decline in U.S.-bound goods. China's exports to the U.S. plunged over 34% from a year ago, their sharpest drop since February 2020. The past 2 months' trade data indicated resilience in China's exports, according to Goldman Sachs, signaling, quote, the difficulty for bilateral tariffs to meaningfully reduce total Chinese exports. Separately, China's urban survey-based unemployment rate in May came in at 5.0%, easing from 5.1% in April to the lowest level since November last year.